How's it going, everyone? This video is going to be a comparison between market structure shifts and the change in the state of delivery. We will also briefly discuss how inversions fit into the equation, so let's hop into the PDF before finding some examples in TradingView. So here we are in the PDF, and we are going to quickly review what a market structure shift is and what the change in the state of delivery is. Now, I have individual videos on both of these concepts, and if you haven't seen them, I would watch those before this video. They will be linked in the description below. But to quickly review, a market structure shift is a change in trend. So it is when we shift from bullish to bearish or from bearish to bullish. Now what it is its displacement over or below a swing high or swing low. So you can see here, we create a swing low, we sweep liquidity, and then we get displacement and a close below this swing low, shifting structure. Now how does this compare to the change in the state of delivery? Well, the change in the state of delivery is not focused on the close below this swing high or swing low, and in this case a swing low. It is focused on the close and displacement below the opening price of this up close or series of up close candles into an important level, validating it as an order block. So you can see here, we displace and close below the opening price, and that creates an order block. Now, how do these two compare on a chart? You can see the change in the state of delivery happens prior to the market structure shift. In this example here, you can see those both occur on the close of the same candle. However, when we get into TradingView and look at a few examples, you can see that the change in the state of delivery will happen prior to the market structure shift. So let's hop into TradingView and go over a few examples of this so it makes sense. In this first example, we are just going to take a look at identifying the market structure shift versus the change in the state of delivery. So here you can see we have a discount fair value gap that price retched into and then closed back inside the range. If looking for the change in the state of delivery, I want to see price closing over this down close candle. Now if I'm looking for a market structure shift, I want to see price displacing and closing over this swing high here. So on the next candle, we get both of those, which validates this order block as well as the market structure shift for price to then retrace or continue higher. And there we go. You can see we retest the order block before moving higher. Now let's get into a few examples which explain the differences between these two and why one might be preferred over the other. Let's take a look at this next example here and look at the differences between the change in the state of delivery and the market structure shift. You can see we have an old high that we hit over here. If we are going to get a change in the state of delivery, we have to get a close below the opening price in this series of up close candles. Now, if we're going to get a market structure shift, we have to get a close and displacement below this swing low. So let's see how this plays out. You can see here price closes below the series of up close candles here, validating it as an order block. So just using the change in the state of delivery, we have now shifted to bearish and looking for this old low over here. However, you can see we haven't shifted structure yet. Here we finally get that displacement and close below this low here, as well as this low. That is our shift in structure. But if you notice, we never get a retracement before running this old low. So rewinding this price action, if I was going to be looking for an entry, how would I do that for the change in the state of delivery? And how would I do that for the market structure shift? Well, with the change in the state of delivery, once we get this close below the opening price here, I can be searching for a short entry. Now, in many cases, I will look to take an entry right when it retests the order block, my stop on the high, and then at my target. However, with a 1.1 risk to reward, what can I do? Well, I can notice there is a fair value gap right here, which I can look to take an entry. And then another thing I will do is look to find the 0.5 or mean threshold of the order block and use that as an entry as well. So you can see it tags in there. And then we hit our TP. Now with this market structure shift, price never retraces and I would have never gotten an entry. The one benefit of using the change in the state of delivery is it can provide an earlier entry to market structure shifts. Now, although the change in the state of delivery can get you into positions earlier than a market structure shift, this is not always a good thing. For example here, if price is going to change the state of delivery, we need a close below this series of up close candles here. And if price is going to shift structure, we'd need displacement and a close below this swing low here. Let's see what happens. So you can see here, we do get the close below the series of up close candles here, changing the state of delivery. Now let's see if we get the market structure shift. So although a change in the state of delivery might get you into a position earlier, it's not always a good thing because it may get you into a position that ends up to be a loser. Where if I was looking for a market structure shift here, we never got displacement or closure below an old low, which is never shifting structure and it remains bullish. So I would have never been looking for a short position here. Now in my last video, I discussed inversions, and they can also be used to signify a change in order flow. If you haven't seen that video, I'll link it in the top right as well as the description below. Let's hop into one more example to explain how all three of these can be used together and which one suits you best. So here we are on oil futures monthly chart. You can see we have buy side liquidity resting here. So let's drop down to the daily chart. So here we are on the daily chart, and we'll go ahead and zoom into this price action over here. And you can see we have the old high resting here, and then we have buy stops resting here as well. So let's let this play out and look at the different ways that order flow shifts from bullish to bearish. So here we get a rate of those buy stops and the old monthly high. Now the three ways we are looking for order flow to change is an inversion. So when this bullish fair value gap gets closed below, when the series of up close candles here gets closed below, or validating that as a change in the state of delivery, or when this swing low gets displaced and closed below, creating a market structure shift. So letting this play out, you can see we do get displacement and it close over the 50% of this fair value gap, but not completely below the fair value gap. So you could consider this inversion, but I prefer to wait for a full closure below. Here you can see we get that inversion as well as the change in the state of delivery, validating this now as an order block. On the next candle, you can see we retest this order block here. However, we do not shift structure yet. We create a new up close candle. Now, if you notice on the next day or the day after hitting this up close candle, we get the move down. Now this is a shift in structure. So now we have had a inversion, change in the state of delivery, and our market structure shift. But you notice the market structure shift happens much later than the change in the state of delivery and the inversion. Now zooming back out a little, what do we look for on a market structure shift? Ideally looking for price to retrace to where? A premium. Well, what do we still have in this premium of the range? An order block. So here we reach into this order block and then get a reaction out of there. And if you notice, we create another order block here. You can see we retest that and then start to continue lower. But the main point of this was to show that the inversion and the change in the state of delivery will occur earlier than the market structure shift. And generally that is used to get in prior to the expansion move. When the market structure shift, you're looking for a retracement to a premium or discount array to get short or long. Now you're probably wondering which one of these is best to use, inversions, market structure shifts, or order blocks. And really it depends on what your eyes see best and what makes you feel the most confident. I personally prefer to use order blocks. However, I know people that use inversions and those that just use market structure shifts as well. It really just depends what fits your system the best and then using that. Overall, I hope you found this video helpful in seeing the differences between market structure shifts and the change in the state of delivery. I hope you go ahead and backtest this for yourself and see which one works best for you. If you guys have any questions, feel free to leave them in the comments below, and I'll see you guys next week. Have a good one.